Let's connect then with Nilesh Shah, MD Kotak AMC, who's joining in on the show. Hi there, Nilesh. Good morning. And I don't know how good it is for the markets. Okay, we're in consolidation mode, but we've been talking about headlines like is 26,000 on the anvil. There were those 2 days of a pretty ferocious rally that played out, despite the fact that FIIs have remained net sellers. What is your sense in terms of the trajectory? Does the undertone remain positive, or is it going to be a very flattish market at hand?
So it all depends upon how you see the things. For me, when markets are correcting, I find it exciting because I'll be able to buy at a cheaper price. Now, to many people, a correcting market will be bad because they will count losses on their portfolio. So the most important thing is the mindset. Is correction an opportunity, or is correction a notional loss which you will convert into real loss through a mindset? We have seen on Friday and Monday good bounce back, but obviously markets cannot bounce back like that forever. If that would have happened, markets would have been much, much higher. The ups and downs are part of the market, and we are in a phase where PE expansion looks difficult. Earnings growth will drive the market. And we have been saying for some time, please moderate your return expectations. Gone are the days when small and mid caps will deliver 30% return per annum for 3-4 years in a row. That's unlikely to happen.
So what should one do now? I mean, start looking at moving back to fixed income, because in fixed income, at least 8-9% return could come, unlike what is expected from equity markets in next 12 to 18 months.
So again, Nikunj Bhai, you have to follow your asset allocation. We have been saying for some time that duration is a good play, and play it with 12-18 month horizon, not with 3-6 months horizon, because in a structurally declining interest rate market, there will be ups and downs. Now, Fed itself is looking at a shallow interest rate cut cycle based on what we have heard in the market and what Fed futures are predicting. If Fed futures are right, then Fed interest rate cuts also will be shallow. And obviously, there will have an impact on Indian interest rates. So my recommendation, this is time to follow, like as always, your asset allocation. In fixed income, go for duration, but with 12-18 month view, not 3-6 months view. Gold, silver, we remain bullish, but again, 3-year view, not 3-month view. And on equity, use every dip as an opportunity to buy. Our long-term fundamental growth story remains intact, but please moderate your return expectation. What you saw in last 5 years is unlikely to be repeated in next 5 years.
Nilesh, this entire earning versus valuation matrix, that was not very favorable till October, and now correction has kicked in. It's 10% on an average, it's 20% on an average for mid cap, 30% on an average for small cap stocks. Is that matrix now looking appealing?
So again, in the market, whatever one says, opposite is also true. We believe there are still low floating stock counters. Some of the counters in railways, defense, capital goods, infrastructure, where we believe valuations are ahead of fundamentals. On the other hand, private banks are trading below historical averages. Auto, cement, telecom, pharma, IT are just trading around historical averages. This is the market where stock picking and sector rotation will become key. This is the market where quality will outperform momentum. Reasonable valuation sectors and stocks will outperform expensive valuation stocks and sectors. And high floating stock market discovered prices will deliver better return than low floating stock counters.
Okay. Nilesh bhai, there is a lot of debate on where the government spending will move and when will the consumer demand revive. If one has to bet on a recovery, is it better to bet on revival of consumer demand or it is better to not bet on demand, consumer demand, but rather bet on revival in government spending? What is a better theme for the market?
So I think, Nikunj, if we see the first half, especially July, August, September, did witness some subdued numbers. Cement consumption was soft, diesel, petrol was soft. GST collection was growing below nominal GDP growth. But large part of that could be attributable to monsoon Shraddh period and government capex remaining low, especially from April to July because of election. Now, if you look at festival season, it has begun reasonably good. Apparel sales were in double digit. The festival season passenger vehicle and two-wheeler sales were either in high single digit or low double digit. In two-wheelers, post-festival demand is better than during festival period. So my feeling is that festival season has given a boost to the consumption. Now we are witnessing wedding season, about 48 to 50 lakh weddings, spending of about 5.5 lakh crore to 6 lakh crore. That should also support economy and consumption. And more importantly, government spending, which averaged about 69,000 crore a month in the first half. If it has to achieve budgeted target of 11,111 crore, then it needs to pick up and reach 1,16,000 crore. I believe there are some of the contractors who have not been paid money. If those monies are released, then certainly that will boost capex also. My feeling is that second half will be better than first half in terms of growth, thanks to festival season pickup, wedding, and government capex if it reaches budgeted target. Put all these things together, you can pick up in consumption as well as in investment some of the bets. In consumption, we are more bullish consumer staples than consumer durables. We are more bullish rural India rather than urban India. And we are still bullish on premiumization rather than mass market. On the capex side, the focus of the government is on road, water, defense. I think here you'll have to be very, very selective in picking up counters because there are some counters where floating stock is limited and hence valuations are ahead of fundamentals. Those businesses will do well, but the investors' expectation at this point of time is so high that it might be difficult to meet.
In the light of the recent election verdict, first Haryana and now Maharashtra, can one say that the focus of the center could be what it was earlier, which is focus on expenditure, focus on railways, focus on bridge building, focus on adding new roads? Because somewhere markets in a sense were confused about what could be the realignment after the political mandate of May 2024.
So undoubtedly, we have moved from majority government to coalition government. And under coalition government, certain things will continue to happen, like digitization, like defense and R&D spending, like infrastructure. The focus will also be on employment, skilling, housing kind of things. The good part was at the center level, fiscal prudence path was maintained, and next year's target of 4.5% on fiscal deficit is a very good target. However, as coalition government, there are certain things which will not be accelerated. For example, strategic divestment looks a bit difficult. Land reform, labor reform, farm reform, judicial reform, these are also likely to be on slow track. So the hope is that with this kind of mandate, government gets the courage to fast track those reforms. With the work which is being done, we are good to get 5, 6, 7, 8% GDP growth on a sustainable basis. But if we want to emulate China, if we want to grow into double-digit growth, then basic reforms around land, labor, farm, and judicial is necessary.
Nilesh bhai, in the light of what the alignment of the world could be, again, we are talking about politics and policies here. We spoke about local elections, but after the US election, the fear that trade tariffs will go higher, it will end globalization, it will have impact on the way how global growth would move. How much of the assumptions of Trump 2.0 from a market standpoint are real, and how much of them are simply not real?
So Nikunj bhai, I met recently with a CEO of a global brokerage firm. His view was that in the first term, President Trump was businessman transiting to president with limited knowledge of how Washington DC works. In the second term, he is 4 years experienced. Second, to win election, politicians make a lot of promises, but need not necessarily that will be executed. So focus on what President Trump does rather than what President Trump promises during election campaign. The third thing was to focus on the composition of team. And he said the composition of team will be very, very critical. Finally, he also mentioned that President Trump will be hard negotiator. There will be America first policy in both local as well as global relationship. As India, my submission will be today, America looks our trade deficit on goods basis at $36 billion, plus all the IT exports which we make. We need to make them aware that there are 279,000 Indian students studying and spending anywhere between $5 to $8 billion. There are 17 lakh Indians who go for vacation to US, and this is restricted by the visa given by America, or these numbers will go up. And they also spend 10, 12, $15 billion there. There are many Indians who go there for healthcare. We as Indian also pay substantial amount to Microsoft, Google, Facebook, Meta, X in terms of advertisements, in terms of other charges. Now, those are not necessarily booked in America. They might be booked in Iceland, Ireland, Bahamas, who knows. So we need to give an entire picture to President Trump saying that our deficit is not as high as you may visualize. This is the real number. We are the only country where, we have allowed American tech companies free access. There's no Twitter in China. No matter what Elon Musk tries to do, he won't get access there. He has access in India. So we'll have to highlight all these things to ensure that we remain in the lower tariff category. We benefit out of America's retaliation against China. And Nikunj bhai, China's trade surplus this year is likely to exceed $1 trillion. There are not many countries in the world who have accumulated FX reserves of $1 trillion. There are only two countries in the world which has exports of more than $1 trillion, US and Germany. China has reached where no country can even imagine to reach. And hence it is important that US's focuses remain on China rather than on India.
All right, it's been good chatting with you. Thanks very much for sharing with us your thoughts on the markets, Nilesh, and what the way forward is.